Good morning, everyone. Join us for our special weekly broadcast. Once again, it's 10 a.m. on Thursday, and we have our 30 odd minute weekly broadcast, and for another fantastic treat today. As you can see from the screen, we've got a number of guests, so I'll just let the guests say a very quick hello now before we hear from later on. So hello to Stefan, Julia, and to Iain. Good to have you all.
Hiya.
Morning.
Good morning.
And we will get straight into what is quite an action-packed one today. So for any new people joining, my name is David Johnson. I'm the co-host of this weekly broadcast. I'm the CEO of Leo Crowdfunding. We're an equity property crowdfunding platform. And my resident co-host, I'll let him introduce himself and explain his background.
John Corey, long-term property investor, US, UK, actually visiting my property in Maui right now. And then most of the time I live in London, though with COVID, it's been sort of interesting. I've been in a few places longer than expected, or not as able to rotate as often. And the focus, when my background is technology and property and investing, and therefore the convergence of tech and regulation. So that's what Property Fortress is really focused on, is that convergence play.
Thanks very much. And this broadcast is designed to sort of provide some educational tips, give some market update, and really just be a focal point for people either tuning in live at 10 o'clock or listening to the recording on YouTube. So if you haven't already subscribed to our YouTube channel, then please do that. And you can get a whole bunch of material. I think it's something like 140 bits of content now on the YouTube channel. There's an Ask John section where you can go in and see all the different topics that have been put to John over that time. So great resource for anybody involved in property to access some information. Today is no different. Today is going to be actually, I think, one of our will be one of our most listened to broadcasts, I think, over time because of our special topic today, which we will get into in a minute. But before we do that, just our sort of quick roundup of what's happening in the world of crowdfunding and Leo crowdfunding. So last week I was on the road. Was down in Brighton visiting the Duke Street project. This project is getting near to paying back to the investors or having their shares redeemed. It was a projected 20% for an HMO refurb. So it was great to be on site. It was a shareholder meeting. So the people in the photograph are all shareholders of this project. A number of them saw this start, John, way back, 11 months ago. Saw it before the refurb started, and they were able to walk through and see the finished article. So it's always nice, John, to see projects sort of come to completion.
Yeah, I mean, I'm one of the investors in this project, though I've never visited it. I sort of, these days, maybe with the gray hair, it's a little bit of I can click to invest, and other people can find the deals, and I do my due diligence. I figure out whether I like it or not, and then hit the button, particularly looking to who's the team, what are their qualifications, how many projects have they done. So you're very much backing individuals, backing teams, sort of like Silicon Valley. You back the team, not the idea.
So it was very interesting to see the reaction from obviously the various investors on this, and very happy, as you can imagine. You see some of the images there. So if you have invested in this, tune in for your share redemption over the next couple of weeks. I'm going to just play this to give people an idea of the location of this project. And they're actually, John, going to be doing a second raise as an income product. They've gone into the holiday lets, and they're going to, downstairs is now let to, I think, a jewelers, and the premises upstairs, the apartments are going to be holiday lets, sort of high yielding, big in demand at the minute in Brighton. And they're offering then investors to come in with a share of the yield. So an interesting way of letting perhaps the current investors then just come straight back into the project and still be involved at receiving an income from it. I think the downstairs was the interesting part, in the basement, this whole communal area with the kitchen and living area and sort of cinema location.
Interesting that they have bunk beds. So definitely holiday let for like a small family or something.
Yeah. And the whole premises it's 7 bedrooms, 20 beds in total. And it's let all at once. You know, literally, it's just, there's no breaking down of that. You literally are are renting the whole premises. So just moving on from there, also attended a shareholder meeting for PLMD and the Becontree Dagenham project. This was 9 apartments that were built with a estate agent downstairs. And for the investors, they're going to receive their first quarterly dividend payment on the 25th. So this week, they're going to receive their payment. So again, picture on the left were some of the shareholders who came to meet the developer face-to-face and hear the update live. And there will be an update going out to the shareholders on that. And then we had an investor network event. 45 people were there. Dal had a chance to explain the process of investing, and AJ and his team hosted the event on their premises in Stratford. So very good night and very interesting. And lastly, this before we go to our special topic today, delighted to report that the Wits House project has drawn down successfully and is now funded, in that the funds have been drawn down and now the project starts. So a successfully raised project. And John, this is someone that obviously you know the fundraiser, and Stefan knows the fundraiser well. Yeah, it was a really good project to do. 375,400 raised from 53 different investors.
Mm-hmm. So Curation Tech and Hitesh are clients. I'm also an investor, one of the 53. Though I'm not saying I have large sums in any of these projects. I take the view that you want to spread it across multiple projects. And this is a commercial to residential conversion, which is not that common for platforms. So it's good to see one like this. And it's somewhat in actually almost Hitesh's backyard, so to speak, compared to some of his other projects. So he's enjoying the fact that he can easily get to the site and keep an eye on it and deal with it that way. So yeah, it was good to see 53 other investors, or 52 other investors.
Mm-hmm. So the Schedule 2, I believe, went out yesterday with the signed shareholder agreement from Hitesh and the fundraiser. So if you are in this one, then look out for your inbox for your share certificate. So let's get straight into today's topic. Delighted to be able to welcome 3 very high-powered guests today, John. So we've Stefan Canavan, who is from Willow Capital, senior debt broker. We've got Julia Southward from Southward-Knightly Property Limited, and Iain Cartmill, who is a chartered financial analyst, ex-hedge fund manager, and someone who invests a lot in property. So welcome to each of you. So I'll let each of you take a minute and just explain your backgrounds and sort of what your current involvement is in property. We'll just suppose go left to right, Stefan, Julia, and then Iain.
Hi, thanks, David. Yes, Stefan Canavan, owner of Willow Capital. We specialise in all forms of unregulated finance, so bridging, development, mezzanine, and also equity with Leo. My background was in the city, then I developed for a number of years, then kind of merged development and finance into broking. And probably our biggest USP is that we're a broker who has actually developed, built houses, converted buildings. So we understand it from both sides of the table.
Thank you.
I'm Julia Southward, co-owner Southward-Knightly Property Limited. My background is more corporate, although I have been property investing for the last 17 years. My portfolio consists of buy-to-let properties and commercial mixed-use development recently with a HMO, but also just recently done our first furnished holiday let, but also now pursuing an accepted offer on a plot of land to develop some new properties. So been investing for the last 17 years and seen a lot of changes out there over those time.
Brilliant, thank you. Over to Iain.
Yeah, Iain Cartmill is my name. Private investor, originally from Australia, now living in Zurich. Long-time property investor in Australia, in the UK, in Switzerland as well. Used to work in asset management and hedge funds, as David mentioned. Now private investor, managing my own money, managing my own HMOs in the UK, my own property portfolio in Switzerland. Equity investing and options trading.
Fantastic. So that's a really good sort of different skill perspective of each of the guests, which leads us in nicely to our topic today, which is around interest rates and the property market. So if you have any questions or comments, please put them into the Q&A, and John and I can pick those up and feed them into the conversation. But I'm going to let John host this. John normally has an Ask John section, so we've kind of combined this week. So on the screen are kind of just some points that will steer the conversation, but just really keen to hear what Stefan, Julie, and Iain, their thoughts on this important topic of interest rates in the property market. So John, over to you. You might want to start with just what exactly are interest rates, perhaps is a good place to kick it off.
Okay, and just for those that are watching live, you can actually change the view you have. So there's some options. So if you have all the different speakers down in a column, you can click a button and actually flip the slide for the speaker. So it depends on whether you want to see the slide or whether you want to see the speaker better. But you can play around with that. It doesn't affect anything else. It's just your view. So interest rates, essentially people rent money and they charge a rental fee. And that rental fee is commonly in the form of an interest rate. So and there may be some religious issues when it comes to specific groups about renting money, usury, that sort of thing. But the real basic point is that money has a cost. It's not free, and you're going to pay someone to use their money for your project. Now, in more modern societies, you generally have something like a central bank or a government agency who sets essentially the foundation, the floor, the base rate, whatever language you want to use. They set the benchmark, and the interest rate that they're setting would probably apply to government issued debt for that country. So in the UK, Bank of England sets the rate. That'll affect government bonds. And then banks who get the money from sort of the UK pools of money would ratchet up from there. They would put some margins above that. If you were dealing in, Stefan will this slightly later, if you're dealing with a finance company who's actually obtaining their money from the US, from a US source of capital, then they may be more sensitive to what the Fed, the US Federal Reserve, has done and what the interest rates are there. But essentially, interest rates are the cost of money. The interest rate is the rental charge for that money that you're going to borrow for some period of time. You're going to do what you're going to do, and then you're going to hand it back with that sort of tax or that fee that you're paying when it comes to the rates. So second question, I sort of touched on who sets rates. It's generally central banks. It's generally at the country level. At the same time, do understand that a commercial high street bank, the people you know, the Barclays, the Lloyds, and NatWest, and all those sorts of people, they're borrowing money, whether from depositors or from other banks or central banks or private investors. They don't have tons of their own money per se. They have a certain amount of capital, but they go out into the open market and they borrow money and turn around and lend that money. So they're paying something for the money they're bringing in, and they're going to have to charge enough on the money to lend out to make a positive margin. So actually, I want Iain to comment on question 3, historical patterns. So Iain, as a CFA, you have effectively qualifications, studied this in some level of depth, and then as an asset manager. So any broad brush comments about historical patterns?
Yeah, I think you've got to be careful how much you use history, because things have changed a lot in the last 20, 25 years. I mean, when I was growing up, I mean, we had a lot of inflation and we had very high interest rates for a while there. But over the last 20, 25 years, I mean, interest rates have been quite low. And the reason has been that the Fed has, and other central banks have targeted much lower cash rates to really stimulate their economies.
Okay, yeah, good point. I don't know about you growing up. I still think of you as younger than me. So I do remember when my first property purchase in California, I was paying 10.75%. I know there was a period that overlapped with my activities. Bank of England the base rate was over 10% for a whole decade. So yeah, we're very historically low, even though we might be ticking upwards. And you're right that the context of history is an indicator, but it's not confirmation of what's going to happen. Interest rates generally should be, not always, but should be higher than the rate of inflation. people should be earning a positive return on their money. There's been very significant periods of time when people did not earn a positive return on their money, where inflation was greater than the interest rate. And then there were other periods which was just the reverse. So the historical patterns are interesting. They're maybe indicative in the little way, but not in the major way. Any other comments for anyone about historical patterns?
I was just going to add to my point. I mean, in 1988, I was in grade 12 at high school. Interest rates in America and also in Australia went up to 18%. And that's the mortgage rate that my parents were paying on their variable rate mortgage at the time. You talk about that sort of figure today, and people would think that you're crazy, especially Fed's funds rate now at about 1.5%, and talk of raising it 75 basis points is creating, a huge alarm amongst many people. But if you compare it to history, it's not very much.
I would agree. Yes, that's a very good point. 18%, folks, and it changed monthly. David, you're almost old enough to know something about this, right?
Yes, but I'm trying to sit in the background today and let
yeah, I know,
but yeah, no, I definitely remember the interest rates high. When we first started getting to buy lets back in 2000, for sure, interest rates were a lot near 10% than 1 or 2%. So yeah. Do
you remember earlier when your parents maybe were buying or selling, whatever their parents did, and interest rates in the 70s or 80s or 90s rather than 2000s?
No, we were out of the UK for most of my early life, so I would have no recollection of that. When living in Papua New Guinea, interest rates in the jungle weren't weren't at top of the list. There was no financial.
How many coconuts?
I know this is Stefan. You're bound to have an input on that from the point of view of just your experience in the market over the last number of years.
Yeah, I mean, I'm slightly younger, but I think a lot of the people who've been involved in property, particularly in recent years, we've been very spoiled, right? Interest rates have not only remained low, but they've remained consistently low. So in reality, a lot of loans that I deal with, some are fixed, some are variable, but in reality, there's been no distinction between them because the base hasn't really been moving. So what we're finding now is people are having to get used to a new way of working and a new way of understanding their loans, because as rates move, they are having a very different impact. And the fact, not only are we seeing rates being higher, we're seeing them move consistently over a short period of time, which means that what you may look at terms 1 month, suddenly, even just 2 months later, there's been an increase. So it's not just that they're changing, it's that they're changing consistently and fairly quickly. Is making it more difficult as well.
Actually, Julia, from a developer point of view, interest rates historically, if we're going the historic route, would, in a rising interest rate environment, home sales slow down, people qualify for less, so therefore developers start to get stuck with inventory. Eventually that feeds through and developers can buy cheaper when it comes to the site they want to build. Are you seeing any signals at all so far?
I wouldn't necessarily say signals at the moment. I think certainly, as you say, the cost of borrowing is increasing consistently over a short period of time. We're currently in a situation we're refinancing a commercial development, and yeah, the rates are creeping up quite rapidly, and there is that risk of the property not being valued at what it could have been 6-8 months ago. So that is going to have a potential detriment impact on what we need to borrow, and what our GDV we've been working to over the past 6 months. But yeah, with the cost of borrowing increasing, will it slow down the property market? Will it slow down the number of, or rather the prices of properties out there at the moment, because they still appear to be hugely buoyant. If that does slow and starts to go the other way, then to investors and developers, that there will be some opportunities. And unfortunately, I think when that kind of happens, where the borrowing becomes very expensive, it starts to narrow the market as to who's able to move in that market. So first-time buyers, for example, will be one of the first types to be affected, I'm sure.
Mm-hmm. Yeah, well, the interesting point that you make is, if you think of a buyer, they have a certain amount a month in their budget they can afford. Whatever the ratio is, however it's computed, sort of doesn't matter. The point is they have a budget, and they'll either be told what the number is by their mortgage broker or they'll figure it out. Well, if you increase the interest rate component, so the top slice, it's the interest rate, on a repayment basis, that means you can afford less principal repayments. So that means to lower their expectations. They have to maybe not pay less for the same place. They have to shift down the market. They have to move to a less expensive neighborhood, a less expensive property, maybe smaller number of rooms or something like this. So that's where you start to see from the buy side downward pressure. When that starts to happen, sales take a little longer. That filters through to valuations, because ultimately I have, say, 100 a month. And if you want 20 for interest and 80 for principal, fine. But if you then say, no, we're going to take 30 for interest, it's like, well, I only have 70 left for principal. So I have to buy a smaller property for the same amount per month. And buyers may have a little flex room, but it doesn't last very long. Pretty soon it's like, nope, we're just going to have to downsize rather than buy the place we thought we could buy. So yeah, historically, rising interest leads to flatlining of house prices. I won't say they fall. I just say that they sort of lose steam. They deflate a bit. They flatline. Then you start to see sellers not necessarily offering their properties for sale, and you find a new equilibrium in the market. So Iain, as an investor, as a cash investor on the other side, so not the landlord that you are, but as the sort of asset manager managing your money, what do you think, or what is the standard way that people behave in a rising interest rate market?
Yeah, you've got two things going on for me regarding interest rates. One, it's the cost of borrowing going up, which is usually not good for most people. But secondly, it's also the availability of credit, because people are usually tightening their criteria. They're imposing other fees and costs to initiate and to maintain the loan. And that also leads to more pressure on the consumer, the investor. For me personally, I mean, the whole situation just creates a lot of uncertainty, because I don't really know what's going to happen with inflation, and therefore I don't really know how central banks are going to cope with their task job of tackling inflation. We know historically that central banks are not very good at tackling inflation. That's not necessarily their fault, because they've got a very blunt tool, i.e. monetary policy, to do it with, and not much else. What they can do is set expectations as best as possible, and I think they are doing that. But at the end of the day, there's still a lot of uncertainty around. But for me as a private investor, I think that the reasons for property ownership and home ownership are still very compelling for many reasons. And if you can afford to take out a mortgage and your financial situation allows you, then I still see people, want to own, real assets, real estate.
Mm-hmm. Stefan, actually, speaking of that, off of that, do you have any knowledge of the percentages of people who are on some sort of fixed rate product versus a completely standard variable product, and how sensitive, therefore, the mortgage market is, the existing homeowners that already have a loan?
I don't, unfortunately. It's something I'd have to research, but I think with the rising interest rates, it is obviously going to impact people who are in different positions. Before we started recording, we were discussing that there is a fair proportion of homes in the UK that are owned without a mortgage. So these interest rates aren't necessarily going to have an impact on them in terms of their mortgages. Then we also have a large proportion of people who have seen this coming, so have fixed for as long as they can, as quickly as they can. So those people are going to be insulated for a while. It's the people moving, refinancing or purchasing that this is predominantly going to affect in the immediate future. But as those people come to sell and rebuy or refinance later down the line, that's when we'll start to see it impact more people, or a higher percentage of people.
Go
ahead, Iain.
Because I was just looking before, 74% of people in the UK have some sort of fixed mortgage. And I think it's since 2019 that like 94 or 95% of people, when they initiate a mortgage, they go on to some sort of fixed loan. But the problem is it's never fixed for a 25 or a 30-year mortgage like a lot of people do. And as a result, you got this thing of uncertainty and expectations coming back in. Like, okay, the rate now is good. It's an introductory rate or whatever, but that's only 2 years or 3 years. Where am I going to be in 2 years or 3 years?
Yeah, someone who fixed at say 2% 18 months ago, if they're on a 3-year fix, if they come out of that and have to remortgage at 4%, it's going to be a very different set of payments and finance structure that they're looking at on personal mortgages.
Yeah. Correct. So
Iain's used can I jump in there very briefly, John? Iain's used the term certainty and uncertainty a couple of times there, and I think that absolutely nails it. And this is where what Stefan's just said, I think there's the element of the professional property person versus, I tend to sometimes get told off using the word amateur, but that's the only word that makes sense to me. So someone who's maybe only, call them inexperienced, it's more the professional experience people have. This great discussion we used to have is, should you go fixed or not? And you're trying to read the economy. If you fix for 5 years, as we used to do, say with the buy-to-lets, and the interest rate comes down, you're thinking, oh, we're wasting all that money. But people will pay for certainty. And it's well worth, I think, in the world of property, paying for certainty, particularly in a volatile economic situation that we have. So I think that's a driver that people should consider when it comes to deciding. Fixed rates gives you certainty over a period of time.
Yeah, and I'd like to say that developers, and Julia can comment if she wants, but developers make their money developing. They don't make their money second guessing interest rates. Where interest rates matter is to exit a development. If you're going to hold it, you're going to have to refinance because the construction loan needs to be paid off and permanent facility put in place. If you're going to sell it, you're going to sell it to end buyers who generally have to go out and get a loan, generally going to have interest rate sensitivities. And it's a bit of a challenge for developers because you're looking at 1 to 2 years guessing what the market will be for prices and interest rates. And the whole GDV is a guess of the future value rather than necessarily the exact number will be certain for the whole period. So you have that uncertainty, and that is the problem with human nature. We don't like uncertainty. So we tend to pull our horns in. We tend to sort of, whatever metaphor you want for like staying where we are, and we're going to wait it out. Well, that lack of momentum sometimes actually has its own impact on property values and things. The real benefit though is that people stay where they are. Is, well, it's still a home. They're still living there, assuming no major family events. Then they don't need to sell, which is why you see values tend to flatline when interest rates go up because people stay where they are. Julia, any comments?
And it's certainly a consideration for those developers now, like ourselves, who have got new projects that won't be completed for another 12, 18 months. Where our exit is to sell the properties, suddenly in 18 months' time, the landscape is changing now in the market, in the mortgage world. So, those people buying the new builds, new properties, it's now a consideration that we've got to be aware of.
Yeah, I think it's also worth touching on developers who are looking to buy new projects now, whether that be a house to refurbish or a development site, because I feel the decision making and thought process they need to go through on that finance, which actually forms a fair proportion of their overall cost, is becoming far more important than it has been before. So when you look at the unregulated lenders, it is quite a different market to the mortgage market. You have large banks operating, you have small funds operating, and I think the questions that developers need to be asking themselves are slightly different. So these types of loans are how the lender responds is going to be strongly impacted by who funds them, where they get their money from. That's going to become quite important, whether it is fixed or variable and what it varies on. There's probably 6 or 7 different types of variable loans across bridging and development. And where rates have remained so low, a variable loan and a fixed loan have effectively been the same thing for the last 3 or 4 years. Now the variable loans are different and varied on different things. And I think I would strongly suggest that developers do start looking into the construct and the funding of their development and bridging loans now, because how they perform over the next 12 to 18 months is going to depend on a number of factors that, like I say before, weren't as important.
Yeah, I think that makes sense. So we're down to about a minute or so to finish off this topic before we wrap up. A couple of questions have come in there. So why do banks have to borrow from the government? Can't they get money cheaper elsewhere? I don't know, Iain, if you have a view, and I'm sure John has a view, but have you any comment to make on that?
Well, usually the transmission mechanism for monetary policy initiates with the central bank, and the central bank then deals with a handful of like authorized dealers, like maybe 10 or a dozen or something like that, and then they deal with the broader financial sector. But usually the cheapest money you can ever get is from your central bank. That's why the whole thing works.
Yeah. In the bridging and development space, the lenders are funded from a whole huge range of sources. It could be private investors, bank deposits, revolving credit facilities, US funds, UK funds, pension funds. There's a whole host of different sources that lenders, particularly in the unregulated world, source their funds from. And where that money is sourced from is going to be impacted differently by changes in rates. So that's then going to affect where their rates are going to go over the next 12 months. So it's not just the central banks that banks borrow money from. The smaller lenders usually are borrowing from people up in the chain as well.
Yeah, sort of combining the two comments there, the lowest cost money is the least likely to default type of money. So central banks are seen as the government or associated with the government. So the lowest cost borrowing will be if you're a government, and everybody pays more than that because everybody's riskier than the government. So a government bond, if it's at 4%, that's what the government can borrow at, fine. But pretty much everybody else is going to borrow at a higher price. So the least expensive money is central bank money. Most developers, most banks don't necessarily get to borrow directly from the central government, or many of them don't, or it's very limited in scope. So therefore, the point is the floor is the central bank rate, and the money after that tends to be more expensive as the risk profile is higher. So, and then you have what Stefan highlighted, which is there are lots of different pools of money. But frankly, if the person with the money says, look, I can take no risk and get 4%, I'm not going to lend it to a developer at less than 4% or even at 4%, because clearly that developer is more risky than the central government or the central bank or the government gilts, the bonds, whatever. So I want a premium when I lend to these other cowboy type rated developer people versus this safe and trusted bank called, central bank. So there's this natural evolution in the market that the riskier projects pay more, and the least risky is the floor for the cost of money.
Yeah, the great risk versus reward, a great principle in life and in business and in property. So last question, and then we'll have to wrap up. Well, I obviously have a strong opinion on this, but I'm not going to give it because I'm slightly biased. So John, this will go to you. Would you expect property crowdfunding sites to do well in a property recession? So have you an opinion on that?
Yeah, I do. There's two types of property crowdfunding. There's the debt side, which is more or less heavily connected to what we're talking about. And there's the equity side, which is closer to like a JV, where you're not lending money, you're actually a co-investor. So what classically happens if interest rates are going up, the lenders are going to be a little skittish. They might pull back till they figure out what's going on, uncertainty, all these other things, and projects don't stack up so well. So you need more equity because you can't afford the debt, or you can't go as high because the lender won't go as high in the LTV, or the lender's uncertain about your exit value, your exit GDV. So they're going to say, we need more equity, we need more equity, we need more equity. So equity crowdfunding sites possibly would have more people coming to them to raise equity. It doesn't mean the deal's any better. It just means they're raising less debt. They're generally going to see they have a higher cost of capital because equity is more expensive than debt many times, not always. And the lenders will be a little bit picky who they deal with. They may cherry pick the best borrowers. They may lower the LTVs. They may, as Stefan said, have some extra fees. Capital is getting more expensive. And that'll cause the developers to say to people with the land, the buildings, or whatever it is that you're buying, I can't afford to pay the same price that I thought I could afford to pay because the exit value isn't there. The cost of funding is higher. I need to put more equity in. So therefore, my project's less profitable because there's less leverage. So all those things will pile up and you'll basically knock down the price of what you're buying so that you can still make the numbers stack up. And therefore, it's uncertain exactly who the winners are and who the losers are, but it's very proportionate. It comes down to any individual borrower, any individual project. When you go to the market, as Stefan said, if you borrowed on a fixed rate 18 months ago and it's a 3-year term, well, you might be exiting that 3-year term at the peak of rates, if that's when the peak is. So all this uncertainty can be very painful.
Yeah, I think that's the makings of a social media post, John. Question asked and your content is the answer. Sounds right. So at the risk of John hitting me with a big stick for going slightly over time, I'm going to put one more quick question to the 3 guests today, and it's like literally a 1-sentence answer. Okay, so the last time when interest rates went up, when you woke up in the morning and you saw it on your phone or you read a paper, interest rates up again, what was the emotion that hit you? Like, what was your reaction to hearing interest rates had risen? So we'll just go Stefan, Julia, and Iain again. Stefan.
Apologies, I didn't realize I was on mute. Recently, not too unexpected, but for me, it's one of caution and being prepared. Obviously, interest rates significantly affect my day-to-day business, so something I stay on top of as much as possible and try and prepare both myself and my clients for.
Brilliant, thank you. Julia?
I think, yeah, I mean, preparation, and yeah, it's coming. We knew it was coming for some time, and it's, you know, there's a lot of properties I've got with variable interest rates on there now, which, you know, it is a concern. It is a concern, and some I'm considering to offload. So mixed feelings. Prepare going forward, but yeah, it's changing.
Brilliant. Okay, Iain, I'm going to give you a challenge. So Stefan was caution, Julia was concern. Can you find a word beginning with C to describe your emotion? No, and we'll keep it nice alliterated.
No, I mean, I wouldn't say it was expected for me, but I mean that when conditions are tightening, and indeed if you go into a recession, there's always opportunity. And in my experience, if people have surplus capital, the uncertain times are sometimes the best times to pick up good assets at good prices.
Yeah, you got the saying, conditions, caution, concern, and conditions. There you are. There's the takeaways. Super, thank you. Listen, a real massive thank you for Stefan, Julia, and Iain today, and thanks John for hosting that. I appreciate that. It says TBC, but I can actually confirm what it is next week, John, because we had just got some texts in during while we were on. So next week we're actually going to have some of the people who did the site visit last week to Duke Street and who attended the shareholder meeting of Becontree. So it's going to be an investor sort of journey through a crowdfunding project at the back end. So we're going to have a couple of investors on who are passive investors and who are going to, if you like, explain their journey of investing, doing site visits, and then seeing their funds returned. And I think that'll be an interesting insight into what this passive investing through crowdfunding is all about, particularly as the question was around if we do head towards more of a recession and people are maybe looking at crowdfunding as an option where perhaps they didn't in the past. That this will I think explain that journey and show the benefits of crowdfunding in a really good way. So that's the topic next week. For those that haven't already, you can go to the link on the screen and you can download the sort of 6 steps to raising funds sort of booklet that has been put out. So you can download that and that will give you a little bit more insight and reading if you want to do that. So that is us for today. And again, a massive thank you to our guests. John, will give you the last word before we wrap up. Anything you want to say?
I think, interest rates are going to go up and inflation is happening. And a lot of the inflation has got nothing to do with central banks. It's got to do with supply chain problems and wars and things. But some of us, at least on here, have been through higher interest rates in the past. Your job is to hunker down. Your job is to take advantage of opportunities. Your job is to monitor and maintain and deal with things. So as an investor, I don't care what side you're on, you have to own this. It's going to happen, so you're going to have to own it. And don't be afraid of it. Just get in front of it.
Fantastic. So thanks everyone for attending. Thanks for the questions were asked. This will be on YouTube within about half an hour. So you can go on and revisit it again. If you haven't subscribed already, please subscribe to the YouTube channel. That goes for our panelists as well. Stefan, Gillian, Iain. I know Iain is already, but Stefan and Gillian, please go on and subscribe and join our community. So thanks everyone. Have a great Thursday. See you next week. Talk then. Bye-bye.
Thank you.
Thank you.
Thanks. Bye.